Randy, can you hear? Haley?
Yes, I can hear.
Okay, good. Okay, I'm just going to place it on mute until the meeting starts, okay?
Perfect. Thank you.
All right.
Really, right there. Now, yeah, we got tap.
No, we gotta make this back. We ain't gotta make we ain't gotta make this. So that's no. So keep going on. Oh, the big man is here. Big man is here. Oh, okay. The chief is here.
Next cop will have 3 cops.
Plenty
of such, you know.
I was like, what last round?
They say, Brian, they run it up down, so we live there, okay?
Come on.
Thank you, Lily. Good morning. We'll call our October 23rd, 2025 meeting to order. This public meeting of the Philadelphia Board of Pensions and Retirement is being conducted in person in the board's conference room at our offices on the 16th floor of 2 Penn Center, pursuant to section 21-1503 of the Philadelphia Code. Electronic recordings of this meeting were made through Microsoft Teams conference technology and by an audio recording. Electronic recording is made available to the public online on the board's website without charge within 10 days. These notifications sent such recording by attending, participating, or speaking at this meeting. Our first order of business today is a motion to adopt the rules that we use and approve for our in-person public meetings that are recorded. The purpose is to help ensure that accurate and complete recordings occur to comply with our code requirements. The motion was made and properly seconded to adopt those procedures. Is there any discussion? Hearing none. Brian. Peter. Marcia.
Approved.
Adam.
Approved.
Paul.
Approved.
Andrea. Approved. And Carol.
Approved.
And two, a motion to approve the meeting minutes from our September meeting was made and properly seconded. Any discussion? Hearing none. Brian.
Approved.
Sheila. Marcia. Adam. Paul. Andrea. Lily. And Carol.
Approved.
Motion carries 7-0 with 1 abstention noted. Item 3, a motion to approve the consideration of applications with 69 withdrawal applications was made and properly seconded. Any discussion on item 3? Third, Brian.
Approved.
Marshall. Approved. Adam.
Approved.
Paul. Andrea. Approved. And Carol.
Oh, approved, I'm sorry.
That was a suspension. Motion carries unanimously. All right, section 4, case 4A, a motion to approve the service-connected disability benefits for Stephen Darden Jr. was made and properly seconded. Any discussion on this item? Hearing none, we'll go to the roll. Brian. Sheila. No. Marcia.
Approved.
Adam.
Stay.
Paul.
Approved.
Andrea. Approved. Lily.
Approved.
And Carol.
Approved.
The motion carries 6-1, 1 extension. 4B, motion to approve the service-connected disability benefits for Jeremy Colton is made and properly seconded. Any discussion? Hearing none. Brian.
Approved.
Peter. Marcia.
Denied.
Adam.
Stay.
Paul.
Approved.
Andrea. Approved. Willie.
Approved.
And Carol.
Approved.
Motion carries 5-2 with 1 abstention. 4C, a motion to approve the service-connected disability benefits for Ronaldo Armand is made and properly seconded. Any discussion on 4C? Brian.
Not.
Rashida. Marcia.
Denied.
Adam.
Not.
Paul. Billy.
Absolutely.
Yeah.
Motion fails 0-7 with 1 abstention. I'll note for the record that board B and board E were removed from the agenda today and we'll come back for a future board meeting, and that leaves us to board F. Motion to approve service connected disability benefits for Brian B. Butcher. Butcher was made and properly seconded. Any discussion on the board? Hearing none. Brian.
Aye.
Sheila. Marcia. Adam.
Stay.
Paul.
Aye.
Andrea. And William. Motion fails 0-6. Oh, I'm sorry. Carol.
It's okay.
Thanks. Nah. What I was. Motion fails 0-6 with 2 abstentions.
I think we should say and really.
And I said, I heard.
I know. My fault. Vice Chair. 4D, a motion to approve the service connected disability benefits for Brian Trago was made and properly seconded. Any discussion on 4G? Hearing none. Brian.
Approve.
Rashida. Marcia.
Denied.
Adam.
Stay.
Paul.
Approve.
Andrea. Approved. Willie. And approved. Motion carries 5-2 with 1 abstention. 4H, a motion to approve the service connected disability benefits for Ashley Capaldi was made and properly seconded. Any discussion on 4H? Brian. Rashida. Marcia.
Denied.
Adam. Paul.
Approve.
Andrea. Approved. Willie. And Carol.
Approved.
Motion carries 5-3. Case 4I, a motion to approve the service connected disability benefits for Maureen Amadio was made and properly seconded. Any discussion on 4I? Hearing none. Brian.
Approve.
Marcia.
Denied.
Adam. Paul.
Approve.
Andrea. Approved. Willie. And Carol. Motion carries 6-2. Case 4J, motion to approve service connected disability benefits for AC Branch Jr. was made and properly seconded. Any discussion on J? Brian.
Denied.
Rashida. Marcia.
Denied.
Adam. Paul.
Denied.
Andrea. Willie.
Abstain.
Jenny. And Carol.
Denied.
Motion fails 0-7 with 1 abstention noted. 4K, a motion to approve the service connected disability benefits for Michael Hardcastle was made and properly seconded. Any discussion on K? Brian.
Approve.
Marcia.
Denied.
Sarah. Oh, Adam.
Stay.
Sorry.
I
Oh,
like her better.
I know.
Approve.
Willie. The vote was 4-3 with 1 abstention, so as chair, I'll vote to deny it, so the motion, one second.
It was 4 or 5.
Four approves.
More approvals, 3 denials, and 1 abstention.
Let me count.
So I have Brian as approved,
Approve.
Rashida deny, Marcia deny, abstention from Adam, Paul approved, Andrea deny, Willie, Carol.
Adam was saying, but did you rather be moving up?
It's the same.
Okay. All right, go get that.
So again.
Thank you.
The roll call was against my fault. Yeah, but so as chair, I vote to deny, so the motion fails 4-4. For L, motion to approve the service connected disability benefits for Christopher Zern was made and properly seconded. Any discussion? None. Brian.
Aye.
Sheila. Marcia.
Denied.
Adam. Paul.
Denied.
Andrea. Willie. And Carol. Motion fails 0-7, 1 abstention noted. For M, a motion to approve the service connected disability benefits for Jason Judge was made and properly seconded. Any discussion on M? Brian.
Approve.
Keita. Marcia.
Denied.
Adam.
Stay.
Paul.
Approve.
Andrea. Approved. Willie.
Approve.
And Carol. Motion carries 5-2 with one extension. For N, a motion to approve service-connected disability benefits for Thomas Cook was made and properly seconded. Any discussion on N? Brian?
Approve.
Sheila? Marcia?
Deny.
Adam? Paul?
Approve.
Andrea? Approve. Willie?
Approve.
And Carol.
Approve.
Motion carries 5-2 with one extension. For O, a motion to approve service-connected disability benefits for Liam Lay was made and properly seconded. Any discussion on O? Brian?
Deny.
Rashida? Marcia? Adam? Paul?
Deny.
Andrea? Willie? And Carol.
Deny.
Motion fails 0-6 with two abstentions. 14, a motion to approve the service-connected disability benefits for Francis Lynch was made and properly seconded. And discussion on the fee. Hearing none. Brian?
Deny.
Rashida? Marcia?
Deny.
Adam? Paul?
Deny.
Andrea? Willie? And Carol.
Deny.
Motion failed 0-6 with two abstentions. Case 4Q, a motion to approve service-connected disability benefits for Linnell J. Lynch was made and properly seconded. Any discussion on Q? None. Brian?
Deny.
Rashida? Marcia? Adam? Paul?
Deny.
Andrea? Willie? Carol?
Deny.
Fails 0-7 with one extension. Note for the record, 4R was also removed and will come back for a future meeting. And moves us to S. The motion to approve service-connected disability benefits for James McEwen was made and properly seconded. Any discussion before S? Brian?
Approve.
Rashida? Marcia?
Approve.
Adam?
Approve.
Paul?
Approve.
Andrea? Willie?
Approve.
And Carol. Motion carries unanimously. 14, motion to approve service-connected disability benefits for John McLaughlin was made and properly seconded. Any discussion on T? Brian?
Deny.
Rashida? Marcia?
Deny.
Adam? Paul?
Deny.
Andrea? Willie? And Carol.
Deny.
Motion fails 0-7 with one abstention noted. For you, motion to approve service-connected disability benefits for Alicia Moore was made and properly seconded. Any discussion on for you? Brian?
Approve.
Rashida? Marcia?
Deny.
Adam? Paul?
Approve.
Andre? Willie?
Approve.
And Carol. Motion carries 5-2 with one abstention. For B, motion to approve the service-connected disability benefits for John Maloney was made and properly seconded. Any discussion? Hearing none. Brian? Rashida? Marcia?
Deny.
Adam?
Deny.
Paul?
Deny.
Andrea? Willie? And Carol.
Deny.
Motion fails 0-7 with one abstention. For W, a motion to approve service-connected disability benefits for Alfonso Murdoch III was made and properly seconded. Any discussion on 4W? Brian? Marcia?
Deny.
Paul?
Deny.
Andrea? Willie? And Carol.
Deny.
Motion fails 0-6 with two abstentions. For X, motion to approve the service-connected disability benefits for Mason W. Potts was made and properly seconded. Any discussion on X?
Just want to mention something. This particular member of the SWAT, swearing the warrant, got shot in the face. And that's a holder. That's a travesty to the people, members of SWAT. I mean, these guys are doing dangerous work. And that was no part of the bill. I want to make sure that.
Sure. Thank you for your comments. Any other discussion on case 4X. Hearing none, we'll move to the roll. Brian? Rashida? Marcia? Adam? Paul? Andrea? Willie? And Carol?
Approved.
Motion carries unanimously. Case 4Y, motion to approve the service connected disability benefits for Ashley and Nicole Pizzolato was made and properly seconded. Any discussion on 4Y? Brian?
Approved.
Peter? Marcia?
Denied.
Adam? Paul?
Approved.
Andrea? Willie?
Approved.
And Carol?
Approved.
The vote was 5-2. Motion was 5-3. Motion carries. For Z, a motion to approve the service connected disability benefits for Ryan B. Rosinski, excuse me, was made and properly seconded at the discussion on Z. Hearing none. Brian?
Denied.
Peter? Marcia?
Denied.
Adam?
Denied.
Paul?
Denied.
Andrea? Willie?
Abstain.
And Carol?
Denied.
Motion fell 0-7 with 1 abstention. For case 4AA, a motion to approve the service connected disability benefits for Sabrina Sokolowski was made and properly seconded. Discussion. Brian?
Approved.
Peter? Marcia?
Denied.
Adam? Paul?
Approved.
Approved. Willie?
Approved.
Carol?
Approved.
The vote was 5-2 with 1 abstention. Motion carries. Case 4B, 4BD, a motion to approve the service connected disability benefits for Olivia Santora was made and probably seconded. Any discussion on 4BD? Hearing none. Brian?
Approved.
Peter? Marcia?
Approved.
Adam?
Second.
Paul?
Approved.
Andrea? Approved. Billy?
Approved.
And Carol?
Approved.
Motion was, vote was 6-1, 1 abstention noted. Motion carries. For CC, a motion to approve the service connected disability benefits for Bernadette Salino was made and properly seconded. Any discussion on 4CC? Brian?
I'll say.
Rashida? Marcia?
Denied.
Adam?
Second.
Paul?
Abstain.
Correct. Yep. Andrea? Willie?
Abstain.
And Joe? The motion failed 0-4 with 4 abstentions noted. Case 4DD, a motion to approve service connected disability benefits for Nicholas and Hoso was made and properly seconded. Discussion on GP.
To be noted that this is the first time Dr. Smith and Israel to be ruled in our favor. But remember, both doctors actually said, yeah, this is probably the first time it's not been. I've seen that.
It's a miracle, right? That's what he said.
Any other discussion? Hearing none, we'll go to the roll in case DD. Brian? Rashida? Marcia? Adam? Paul? Andrea? Lily? And Carol? Motion carries. Next, slate for E to E. A motion to approve the service connected disability benefits for Delano Trippett was made and properly seconded. Discussion on double E. Brian?
Approved.
Rashida? Marshall?
Denied.
Adam? Paul?
Approved.
Andrea? Willie? And Carol?
Approved.
Motion carries 5-2 with 1 abstention. Case 4FF, motion to approve the service connected disability benefits for Ismael Vasquez was made and properly seconded. Any discussion on 4FF? Brian?
Denied.
Rashida? Marcia?
Denied.
Adam? Paul?
Denied.
Andrea? Willie?
That's pretty.
Carol?
No.
Motion fails
You're
0 to 7 with 1 abstention. For double G, motion to approve service connected disability benefits for Deborah Stewart was made and properly seconded. Any discussion?
Not.
Sheila. Marcia.
No.
Adam. Paul.
No.
Andrea. Willie. And Carol, I'm sorry, I don't have your G here.
Double G.
Double G.
No,
Voting
no
no.
two.
Motion fails 0 to 7 with 1 abstention. For double H, a motion to approve service connected disability benefits for Alton Barnett was made and properly seconded. Any discussion on double H? Brian. Sheila. Marcia.
Approved.
Adam. Paul.
Approved.
Lily.
Approved.
Carol.
Approved.
Motion carries unanimously. For double I, a motion to approve service connected disability benefits for Lily R. Rogers was made and properly seconded. Any discussion on double I? Brian.
Approved.
Rashida. No. Marcia.
Deny.
Adam. Paul.
Approved.
Andrea. Willie.
Approved.
And Carol.
Approved.
Vote was 4 to 4, and as chair, I'll vote to deny, so the motion fails 4 to 5. Moves us into old business. And case 5A, a motion to approve service connected disability benefits for Derek L. Story was made and properly seconded. Discussion. Hearing none. Brian.
Denied.
Rita. Marcia.
Deny.
Adam. Paul.
No.
Andrea. Willie. And Carol.
Deny.
Motion fails 0 to 8. These 5B, excuse me, motion to approve the service connected disability benefits for Maria Blasted was made and properly seconded. Any discussion on 5B? Brian.
Approved.
Rashida. Marcia.
Deny.
Adam.
Approved.
Paul.
Approved.
Approved. Will.
Approved.
Thank you.
Approved.
Motion carries 6 to 2. Case 5C, the motion to approve the application for service connected disability benefits for Christine Emilio. Stated for the section. Any discussion on 5C? Brian.
Approved.
Rita. Marcia.
Deny.
Adam.
Approved.
Paul. Andrea. Approved. Willie.
Approved.
Approved.
Motion carries 6 to 2. Case 5D, a motion to approve the application for service connected disability benefits for Pinata and changes made and properly seconded. Any discussion on 5D? Brian.
Approved.
Rashida. Marcia.
Deny.
Adam.
Stay.
Paul.
Approved.
Andrea. Willie.
Approved.
And Carol.
Approved.
The vote was 4 to 3 with 1 abstention. As chair, I'll vote to deny, so the motion fails 4 to 4 with 1 abstention. Case 5E, a motion to approve the application for service connected disability benefits for Aaron F. Johnson was made and properly seconded. Discussion on 5E. Brian.
Approved.
Rashida. Marcia.
Deny.
Adam. Approved. Paul.
Approved.
Andrea. Approved. Willie. And Carol.
Approved.
Motion carries 6 to 2. Case 5F, the motion to approve the service connected disability application for Kevin J. Lewis was made and properly seconded. Any discussion on 5F? Brian. Sheila. Marcia.
Deny.
Adam. Paul.
Approved.
Andrea. Willie.
Approved.
Approved.
Motion carries 6 to 2. 5G, a motion to approve the service connected disability benefits for Kenneth Novak was made and properly seconded. Any discussion on 5G? Hearing none. Brian. Sheila. Marcia.
Deny.
Paul.
Approved.
Willie.
Approved.
Motion carries 5 to 2 with 1 abstention. 5H, a motion to approve the application for service connected disability benefits for Reese R. Walker was made and properly seconded. Any discussion on 5H? Brian.
Approved.
Rashida. Marcia.
Deny.
Adam.
Stay.
Paul.
Approved.
Andrea. Willie. And the vote was 4-3, with one abstention, as Carol voted to deny, so the motion fails 4-4, one abstention. 5I, a motion to approve service connected disability benefits for Alberta EK was made and properly seconded. Any discussion on 5I? Brian?
Approved.
Nikita? Marcia?
Deny.
Adam? Paul?
Approved.
Audrey? Willie?
Approved.
Mike? Carol?
Approved.
Motion carries 5-3. 5J, motion to approve service connected disability application for Wilford A. Baker was made and properly seconded. Any discussion on 5J? Brian?
Approved.
Sheila? Marcia?
Deny.
Adam? Paul?
Approved.
Andrea? Approved. Willie? And Carol?
Approved.
Motion carries 6-2. 5K, motion to approve the service connected disability benefit application for Brian P. Kehoe was made and properly seconded. Any discussion on 5K? Brian?
Approved.
Rashida? Marcia?
Deny.
Adam? Paul?
Approved.
Andrea? Willie?
Approved.
And Carol?
Approved.
Vote was 4-3 with one abstention, and as chair will vote to deny, so the motion fails 4-4 with one abstention. 5L, motion to approve service connected disability application for Mark Moretti Jr. was made and properly seconded. Any discussion on 5L? Brian?
Approved.
Sheila? Marcia? Adam? Paul?
Approved.
Andrea? Approved. Willie?
Approved.
And Carol?
Approved.
The motion carries 5-2 with one abstention. 5M, a motion to approve service connected disability benefit application for Daniel Pellicati was made and properly seconded. Any discussion on 5M? Hearing none. Brian?
Approved.
Rashida? Marcia?
Deny.
Adam?
There.
Paul?
Approved.
Andrea? Willie?
Approved.
And Carol?
Approved.
Motion carries 5-2 with one abstention. 5N, motion to approve the service connected disability application for Kevin Sizer was made and properly seconded. Any discussion on N? Evan? Brian?
Approved.
Rashida? Marcia?
Approved.
Adam?
Approved.
Paul?
Approved.
Andrea? Willie?
Approved.
And Carol? Motion carries 7-1. 5O, motion to approve the application for service connected disability benefits for Charles Whitaker. The fourth was made and properly seconded. Any discussion? Hearing none. Brian?
Approved.
Sheila? Marcia?
Deny.
Adam? Paul?
Approved.
Andrea? Willie?
Approved.
And Carol?
Approved.
Motion carries 6-2. 5P, motion to approve the service connected disability application for James S. Williams Jr. was made and properly seconded. Any discussion on P? Brian?
Approved.
Sheila? Marcia?
Deny.
Adam? Paul?
Approved.
Andrea? Willie?
Approved.
And Carol?
Approved.
The vote was 4-3 with one abstention. As chair, I'll vote to deny, so the motion fails 4-4 with one abstention. Last case, 5Q, motion to approve the application for the service connected disability benefits for David K. Young was made and properly seconded. Any discussion? Brian?
Approved.
Sheila? Marcia?
Deny.
Adam?
Approved.
Paul?
Approved.
Andrea? Willie? And Carol? Vote was 5-3, motion carries, and then moves us into the new business and the executive.
Annual CLA audit should be getting underway shortly. It's at this time last year when we first started. We have a new auditor on CLA that would begin our audit review. So reached out, it should be started soon. State audit is still in process. We haven't heard anything in a couple of weeks. We'll provide an update on anything. January or February, we'll likely come to the board with a request for an RFP at database provider. I think there's any issue with the database provider. There are a couple of new companies out there. You know, but one is coming out. That gave a presentation at the education conference. There's a couple of new companies. There's new technology out there. So I think it's important just to know what's out there. The Social Security database isn't as advanced as it used to be. Not used as much as various other sources being used. I think probably isn't generally the same things, but I think it's worth seeing what's out there and report back to people. So we'll be hearing about that in a couple of months. The service connected disabilities, just as a comment, you can see there's a large number of existing applications. So you're seeing that for the church. Currently, over the last month and a half, we have seen a considerable decrease in the number of initial applications. So at some point down the road, we'll be seeing that also. But as the cases continue to move their way through the system, I think you'll see this larger amount of cases, maybe not as large as today, but for large amount of cases. On that note, I did, only because we all pointed out a lot, I tried to make like Denise and Taisha, I wrote a thank you. I know it's not easy, and it's a quick turnaround in these cases, and I know the trustees appreciate it. I appreciate it. More importantly, the members appreciate it. Because they get their matters heard. So I know it's not easy. I know it's frustrating, but I appreciate it. And I just wanted to, Henry, see if you could do any hearing panels. I've been getting a lot of feedback. You're doing a good job conducting hearings, but remember, you're showing a lot of interest towards integrity. That's cool. So I appreciate that. Concerning the trustee elect, you're all fired up today, aren't you? The trustee election. So the ballots did close yesterday. Serving the close of business yesterday, the ballots closed. The official count is in person at the board on Wednesday, October 29th at 10 a.m. on the 17th floor. So, no matter what happens, thank you all. Good luck in the election, and I look forward to some good results next week. The pension payroll modernization project continues. There's a lot of preliminary work, So I've been meeting the last 2 days with project. We'll get project opportunity to get a brief update what we're doing with our work.
Absolutely. Thank you, Brad. As Brad indicated, we've been having a lot of meetings and going through the details for what's upcoming, which is kickoff and then eventually we will keep pointing our. There are going to be a number of meetings, including the subcommittee of trustees as well. Two, what we had
So those of you on the subcommittee, as members of the board, Lawyer's office and the Brian, we had passed this subcommittee. I tried to. So we should start keeping up with those people. Integrating everyone along the essential HR. Everyone is I'm optimistic. We'll be very fast. There's an educational conference report in there. You can see that. There are two conferences in there. One is the papers fall workshop, which is in there. A couple of people have already expressed interest in that. NC PERS is also in there.
Okay, I'll make the motion. Any trustee or staff that wants to attend you pick up for the legislative.
Second. Motion is made and probably seconded. Any discussion? Hearing none. Brian. Marcia.
So I just want to say, and thank you, Fran. And I want to thank staff for doing a job on these cases, but even in the too many cases. And I understand, I know the members need to be serviced, but this is a lot, and we're getting them on the weekend. That means I'm spending my whole weekend trying to read 35 Applebit cases, and then we get into the double Applebit cases, and then we get to the hearing panel cases. So, and again, I can remember when the members, and that's not saying it's right. I'm not saying that was right a long time. But I can remember we couldn't get nobody to the hearing panel, so we had to back up line. I'm not saying that, but in due respect to the members and in due respect to our duties as fiduciary, we need time not only to do the cases, but to also read and talk about the investment side. And that's a lot. So we got the cases, and then we got to do the investment side. And sometimes their report is like a library. So I'm just asking for consideration on when y'all doing these cases. If we have to cut back, we just have to cut back, or something got to be cut back. It's not fair. I know to me it's not fair, and I'm going to speak on me. It's just a lot. And we all have other jobs. I understand that we all have other jobs. And then cases we get updates, cases deleted, cases improved. I'm missing cases, and I know because there's a lot for staff to do when you talk about and to your point, Fred. No, we had 2 months ago, I think it went to 4PP. So that UNP, you like 7 letters from the end of the alphabet again on the double side. So that's a large amount of stuff to do. Like for me, and I know I'm the same, reading and all that, and then we got to do the investment side. It's a lot. All I'm asking is some consideration
Yeah, we're happy.
for the number of cases that we're getting, and then the other obstacles that we run into. So, in fairness to the members as well, you know, I know for me, I'm about lost sleep, waking up, about to set the alarm. Let's go back again. So it's a lot. I'm making a fun of that. But anyway, it is just a lot of cases to do. That's the good.
I think it's a good point. And starting to hear, but you're not the only person that has mentioned that. There are a couple of things that we can finalize less cases to come to the point, and as a result, probably that. So if we continue with this number of cases, turnaround is so tight, I don't want to send them out piecemeal. So we can reduce the number of cases that come to. But as a staff and as trustees, we'll have to answer to the calls and inquiries that we get, and we have no problem doing it. And so I understand. So that's an option. I do think they will go down over the next several months until as I indicated. But yeah, we can reduce the number of cases.
Is it reducing or is it just a timeline that we cut off? Whatever makes the cut.
Well, we do that, so we can move that time.
That's what I think, and if they
At
suggest.
least a couple of days.
If
I get it.
there's enough cases that are done, let's see them. I don't want to cut the number down.
I agree. And I agree with Carol. I agree with that. Other people have told me that, without mentioning any names. And it's just as difficult for us to get through the cases. As Carol pointed out, a couple of things slip through and then we have to pull the case back, and we don't want it. I think it's not a good look, right? So I get it. So
What
yeah,
is the suggested cutoff? While we're on it, Carol,
we'll move it back. Why don't we move the cutoff back, whatever it is, by 3 days? And then that should reduce the balance here. Additional time that includes weekdays, not just a weekend. And we also can move the prep unit back again. Doesn't have to be Monday, be Tuesday, 4 meetings on Wednesday. We can, I think, 4 meetings on a Thursday, which is always, we could have a prep meeting on Wednesday, or later on Tuesday afternoon. So there's a lot of different ways we can squeeze a couple of days, 2, 3, 4 days, normal work days that doesn't do that. So, yeah, I get it, Carol. We'll
Yeah, and I don't wanna jam the staff up and put them in a position where they're rushing. So I think the cutoff should be both, it should be, this is the day when the case can go through, and this is the day when we gotta have it out. So it gotta be on both sides. Some of the cases may not get it for that month, they may have to wait till the next month.
Yeah.
And like I said, that's not, but, disrespect and everything like that, but we gotta be able to do the job on both sides. In
No, it's a
the
good
proper
point.
manner.
It's a good point.
So we gotta be able to, as trustees, we gotta be able to not only do the cases in this building, but we also gotta be able to pay attention to the investment side as well. So you missing here and something flipping up over there. So it's two things. For me, it's both sides we gotta be able to do. So yeah, we need to look at the timeline, not only in the jail, but we all work different jobs and other committees and stuff like that. But we need to look at maybe like, okay, all the cases, whatever case we're gonna do, the cutoff date to get them through and however y'all do on y'all side is Thursday. But they gotta be to the trustees by Thursday. I'm not even saying push it out by Wednesday, but maybe you give me another date behind, but that's like, but now I'm pushing on this side, like closer to the meeting to get stuff done, you know what I'm saying? And if there is problem, we don't have a window, we have a small window to contact the office, let them know what the situation is.
I'm glad you brought it up. I agree with you. We know they're really happy and, well, I should be.
Anytime.
No, it's a good point. Thanks for bringing it
Put
up.
numbers to it, people at this table understand, but other folks in the minutes may not. We had 150 ordinary applications, we had 52 disability. It's over a third of, it's significant. You're not just complaining here. But we want to get them out. The members deserve it, and we will. Maybe move the cutoff, and I think.
We'll work on that. It's a balancing act, and trustee is a fiduciary duty, and that includes being able to read the cases, and analyze the cases. I'm with you. I get it. So,
Yeah, but I'm telling you, I remember, y'all, they didn't even get to see a doctor for like 6 years, okay? So when I got on the board back then, we was waiting 6, 7 years for them to even see the doctor to make a decision. So this, it's a whole process, and I'm not saying anything about risk management. It deal with the process and everything was backlogged and stuff like that. So I'm not saying, well, they had to wait, that's not what I'm saying. I'm saying just give us the opportunity to do things right way.
I'm glad you brought that up too, because we're so darn.
Oh, you know, Frank, yeah.
I do. I remember. I was worried about it.
Right.
But I remember we're so darn efficient now with our partnership with risk management and with ensuring our communication with the doctor. Everything's moving so, and risk map prudence is still there. Everything's moving so efficiently that we are getting people to the doctors much quicker than it was back then, Carol. So the cases are getting to us quicker and more efficiently also. So that's a good thing. That won't change. But the time the cases get to you, we need to keep earlier and do less cases. So I mean, it's going to work on it. Happy to meeting to that. Thanks for bringing it up. And the litigation summary is in there. I did talk to Alan, Barbara can't be here today. He said just tell her she's very busy. And she's in there today, that's why she's not here.
That's it, all right. I will now turn to that.
Put you up to that? I don't know, maybe yesterday.
I'll take a 10-minute break.
Yes. Sorry. Yeah, sorry, your call.
Really? First item is approval of December 23rd. There a motion? Thank you. Motion, Robert second, all those in favor? Aye. Any opposed? Any abstentions? Motion carries. And item 2. Update.
Good morning, everyone. Executive summary for September. So 7 asset balance is 2,904,549,138. That is 1.7% increase from the month of August. Planned participants total that have been comes out to 27,688. That's 70 more than the previous month. Participants contributing is 20,828. That's 47 more. And if you look at the total penetration, it's around 75% of participants are actively contributing. 304 new enrollments received in September. Year to date, since it's in the end of third quarter, total enrollments received is 2,110. That is 26% above last year. 401A asset balance is $7,248,921. It's 2.4% increase from the month of August. Planned participant count is 2,101, which is 5 less due to separate from service and transfer.
Good story, Mark.
Okay. Philadelphia Parking Authority, 669 with 1 new enrollment, and for Housing Development Corporation, 48, no changes from previous month. When we look at raw balance, that's the after-tax contributions, it continues to increase. The balance is now at $124,858,268. In terms of participant count, it's 9,925. That's 145 more than previous month. The utilization aspect is 36%. It has gone up by 1% from the previous month. When you look at percentage contributions, it's 3,658. That's 135 more than the previous month. Penetration also went up at 18% of active participants are utilizing the percentage option. In terms of call volume, it did go up. It's 3,361 in September, about 452 more participants. Again, at the end of quarter, people do receive their statements, so call volumes do go up. Participants with account balance is 22,245. 153 more folks have actually set up an online account where they can view webinars and wealth of information. The penetration rate is at 80.
Dina, do we know the reasons why people call? Like, what are the top, 3 reasons why they're called?
Oftentimes the statement drives, a proper review, asset allocation, but inquiry just to understand. And there is also a call volume increase due to folks that are inquiring about contribution increase, etc. So when we also send out a participant engagement, as you know, information, email outreach, and at the end of September, we saw a 50% unique engagement. What that means is that the PEP program sends out emails and the call volume did go up because of those email outreach efforts. 27% was due to call volume rate, understanding the tools, as well as contribution.
Yeah, because the reasons why people call could drive, to your point, the communications that you send out to members. So if people are saying they need more information about understanding the plans, ensuring that the points that they're asking, that we hit upon those points as a part of the communication. And where are the people calls coming from? Is it people in 33, 47? And I know we're going to try to work on that.
Yeah, it would be hard for us to determine by department. However, we could give you the call volume inquiry. We can give you the breakdown of the reasons why they're.
Okay, reasons is good. It's a good start.
I've been happy to follow.
Okay, all right.
Can I ask you a question? Back on page one, the activity report,
Are you on, sorry, yep,
we've talked about this before and very briefly stabilized, but this month again, you had 30 members roll over into the plan, you had 47 roll out. That's 60% more than rolled in. And that's been a trend for a couple of years now, a very brief period of stabilization. Why is that? Because of course, our job is just to make sure these members think this is the best plan and they forget. And rollout means retirees, right? Active members cannot roll out. So are we serving retirees properly? Because this trend has continued for years. I just want to see why is that?
could be due to dollars flowing out, relationship with, having investments outside with financial advisors. I don't know the reason why, but often we are seeing in other plans the trend of, sometimes it's due to relationships, sometimes it's due to the investment options. Sometimes it is due to, making sure that they need the dollars, but there are various reasons why. A few things that we have done to ensure that retirees do get the education. We recently did, in partnership with HR, we did a communication to those folks that are heading towards retirement so that we can provide education on the value of the clean assets within this plan.
I'd like to see, because I think it's because the interest rate is 2.6% on your guaranteed account, which is where our retirees focus their efforts. They're not taking risking. For the most part,
Yeah.
generally speaking. You do have plans in the country that offer quite a bit more than 2.6. I'd like to see if that trend is happening with plans. And I bet you it's just, and that's not directed at you, you're just speaking, that's directed at Nationwide. I would bet you that that trend is not the same for the plans they're offering upwards of 3%. And I know you have plans in the country that do that. I don't know if that's something we can withhold on or not. I'd like to see that.
I do know that the members actually being their main reason for it. Different, not what was drawn. It's the interest rate to stable.
Yeah, because you can get, the credit unions, both of them have a high yield.
You can double it.
High yield account that is double the interest rate that that's receiving there and as far as that with. Then you want to get 2 cents from the money anyway.
Really gonna ask people when they roll out, why they're doing
Yeah.
It depends on who they're calling. I think if they reach out to Sean or Christina, the local reps, they're going to inquire, try to retain the assets within their plan. They're calling our customer service and just give them somewhat our general customer service area. Their way of operating is typically, here's my need, here's what I'm asking for, and they're kind of providing that without taking a step further. So a lot of that could be dependent upon who the participant each comes in to ask for.
And if they do reach out and we report the reason, should we calculate anyway, and track it, or how does that work?
I don't think if they're calling our home office and asking for rollovers out of the plan, or we tracking that, I would have to go back and see if I can really speak. Sure.
Do we know if Nationwide has a high yield, interest rate, product that they can offer the members that may to catch the eye? Because, like I said, I know both police and fire and federal have a high yield account, and if they're rolling over the money, it's a lot of money. You don't only put $20,000-$30,000 account and only get like $2 interest from a regular account. So they could do it a little bit better with the high yield account at the credit union, and that's probably what's happening. I'm just guessing, but I do know they had a legal account.
So if I can, one, appreciate the question. Right? And it's a fair question. We're always looking for ways to add value, right? Where we can. And so to the point around, is there like a money market type option or something like that that would be more high yield? Those, just a reminder, those are tied to short-term interest rates. So those products could be available for the board's consideration if you want to add a side-by-side option, but there's risk with that too, right? Because they're tied to short-term interest rates versus the fixed. And just to give an example, and I brought up just some data here. So when you look at the overall portfolio, the fixed accounts, it's our 10-year here, in Philadelphia has ranged from 2.5 to as high as 3. Today it's at 2.6. When you look at the average 10-year treasury over the period of this is looking at from 2017 to 2024, you go 71%, almost 72% of the portfolio was invested in the fixed account in 2017 when the 10-year treasury was at 2.1%. You go to the following year, 2018, roughly 3.7% of the portfolio was invested in the fixed account when the treasury was at 2.9. Then you go almost a little over 3% in 2009, or 2009 rather, was invested in the portfolio when the 10-year treasury was at 2.1. But then there was another large inflow, and this isn't surprising, right? When you think about what happened in 2020, there was a large inflow into the 10-year treasury, or excuse me, into the fixed account in 2020, almost $73 million, roughly 11% of the portfolio, when the 10-year treasury was at 0.9. Right, so those are the times when dollars are coming in, dollars are being invested, and you look at what they're buying at that time. Right, unfortunately, the cycle has not been on the side, if you will, of Philly as far as higher interest rates, because when dollars have come in, the 10-year treasury has been low. Recently, now if you fast forward and you go, okay, 2023, the 10-year treasury was at 4%, but you were at a negative position of negative 1.5, so that meant more dollars were leaving than coming in. So therefore, you weren't able to take advantage of that higher interest rate at that time period. And then again in 2024, when the 10-year treasury was at 4.2, you had roughly about a little over $22,583,000 for roughly negative 3.4% outflow from the plan. So again, it wasn't an opportunity to buy. Now, some good news, right? And we've talked about this recently, is there has been some stabilization. And we're hoping that, that were to continue as far as outflows from the fixed, right? And interest rates were to stay relatively the same. There's a path forward where we could see an increase in that rate, which is what we want to do too. We want to bring that value to the participants. To your point, the retirees, but also to the active members, right? Everyone, if they're a fixed investor, we want to try to bring maximum value to it. So it's part of just trying to figure out, ways to stabilize the assets that are in the fixed. So therefore, we'll have the assets to buy into the marketplace currently when it's more favorable, if you will, than it has been historically in the 10-year that we've been.
Yeah. Oh, you're kind of repeating what I said. This has been a long trend. You put dollars to it, which I appreciate. Big dollars.
Yeah.
We're going to blame the members for chasing a better rate. That's why we would keep the rate low. That's what I get out. And it's the Nationwide's job to invest those monies in products that they choose and produce a return high enough that our members can benefit from the market cycles. We've gone through an entire cycle with the interest rates, but it's coming back down now. It seems like we'll keep coming back down. And I think the story a year from now is, well, interest rates are really low. We can't. What about when they were really high? We just talked about. You're saying we couldn't participate because we took dollars out. Members went and they doubled their rate on the street that they were getting when they were playing. And they're being punished for it. That's what I heard. Correct me if I'm wrong.
So I wouldn't say punish. What I would think about is what's the primary objective of the fixed account? The fixed account's primary objective is protection of principal. That's its primary objective. So its job is not necessarily to try to maximize interest rate environment, because it's a longer term view than a money market or some other type products where they're tied to shorter term instruments, right? This has a longer view. So when you think about the participants at the time when interest rates are at 0.9 and they were getting, 2 points, somewhere between 2.5 and 3%, right? There wasn't that same concept that they were being punished, but their principal was being protected when some of those instruments were close to losing value. So that's where it's kind of weighing that out as far as going, what's the objective, what's the goal, and the objective and the goal is asset protection, principal protection, and that's exactly what the fixed account has done. And it's provided a stable manner so they're not subject to the swings of the interest rate market that you can have. It's folks think of fixed instruments, and I think generally, and I know this board is way more sophisticated than the everyday populace, but right when they think about it, they think of, like to your point, just they don't think of loss of principal, they think of like a bank account, right? But in these short-term instruments, you can have a loss depending on what the interest rate environment does. And so that's where it's important just to measure that out, if you will, that this fixed account has provided just that, the stability of the portfolio, a smoothing effect where they haven't gone ahead of swings of the interest rate market that we've seen going from in 24, 4.2 to as low as 0.9 in 2020, and their principal has been protected.
It has been, I don't think, a fair rate. Nationwide gets to hold on to billions of their dollars and invest that money. I assume you're investing it, making a return in the market. I don't feel like they're participating like 2.6. It is protected, but they should be rewarded fairly for allowing Nationwide to hold on to that money. But that's why the money's going elsewhere. But they don't feel like it's unusual to cut them. Otherwise, the money would stay. If you go back to what you just referenced back when interest rates, was 0.9, I bet you the trend was the other way. I don't have the numbers. I bet you paycheck that there was more coming in than was going out because the value was here. That's our job.
You're not mistaken, but that's the challenge, right? When we're able to buy into instruments into a portfolio, the 10-year treasury, for example, in 2020 was at 0.9. So that meant that the set roughly $73 million that flowed into the portfolio in 2020 was buying into a marketplace where the 10-year treasury was at 0.9.
But keep referring even earlier, first 10-year treasury is measured still. I've seen what the fund is composed of. It's composed of mortgage-backed securities, it's composed of multiple asset classes, not just the 10-year treasury you're using as a measuring stick. So that's a little misleading because it's a wide array of fixed income products that fund is composed of. So I don't want to focus exclusively on the 10-year treasury, although that's focused on when you hear the Fed talking about interest rates. I get that. But this that the Nationwide fund is much more than the 10-year treasury. And what you also said, and this is a reference to Brian's point, is that during that time when interest rates were low, the participants were getting 3% or less. We negotiate 3%. You don't get to say, well, because we didn't make a good negotiation, got our members 3%, and now they have to pay on the other end and have a lesser rate because we have to make money back, which we haven't said that specifically. That's basically what you're saying. And it's you don't get to say that this fund is for the long term and we have to pay the price in the short term. Because we know from the RFP, right, that Nationwide has to make a certain profit. We know it's in the RFP, right? And we know from the regulatory laws that we want to quality guarantee that the return of the sponsor of the guarantee fund, which is National, has to be higher than what we're paying. We know. So we know there's a profit, which is what Brian Jim also wanted. I asked you, is the RFP also says you're not allowed to disclose the actual return to us, which we can talk about that before. We've got a lot to do today. But Brian makes a good point. When I fiduciary to this fund, trustees need to know that what they're recommending for the members is the best possible product for whatever the purpose happens to be, whether it's a progressive growth fund or a fixed income fund that is available. So that's the essence of Brian's question. We could go back and forth a million times, various ways to measure the investment. You have to use the 10-year treasury rate, but I think it's much more complicated. So we maybe can set up another subcommittee meeting offline to talk more details about that because we were optimistic that the upcoming quarter would see an increase in the rate. We were all anticipating that. I think even Chris would tell me he was anticipating that. And we were highly disappointed when that was not the case, especially with the trend of interest rates and the commentary of the Fed for those interest rates. So, we've been generally unhappy with it, but it's particularly now, given the expectation, it was a big disappointment to us. And I'm sure to the members. So, say we're right or wrong, saying there's different ways to measure it. I think when you think over time, and
We're happy to have those conversations, and if you walk away from the table, just know that we want to bring value to your members, right? We do, and so it's working through what has been a challenging marketplace for a fixed income investor on both sides of the pendulum. But we're gonna look forward to that opportunity to continue that conversation and I look forward to the path of the future report.
I have a question from last meeting.
Thank you.
I had a question last meeting about, eligible employees, for the 401 and like, do we have that number that come in are eligible that aren't participating?
So thank you for asking that question. We have all of them, we're working with the One Philly team, and Chris, to get that list, identifying the individuals that are eligible, to get the match, but that list is now, in progress. In the meantime, what we did do is get all the marketing ready. The marketing is all prepared for outreach content, party members that are not in deferred compensation plan, as well as Plan 16. So right now, we should get that list soon. Once we get it, we will do the outreach to those individuals and provide an update at the next meeting. Thank you. There's other.
Yeah.
Thank you. Thank you.
Are we finished?
No.
We're not finished yet? No, okay, so I got some questions.
Sure.
Okay.
So questions related to what we just discussed.
Everything, yeah. So not the, I already talked about the interest rate with Brian. My thing is that is how you account that. I think they can look at, will look to see the room to put into that fixed income.
Okay, so we had a
That-
separate meeting, you want
that-
to do that there or you want to do it right now?
Well, okay, so then the 401, in reference to Christmas, so last year, oh my God. Last month, we had discussion
Felt
about,
like you.
I know it did, right? We had discussion about the message that was being sent to members because they're not getting into the 401A, even if they are eligible, because they're not at the cap market. So we have to talk about that. So I think Chris, I'm requesting that we have an education committee meeting. So, because there's some other stuff that me and Marcia need to go over with y'all. I think we need to develop the message that we send to the members so that, Chrissy, to your point, that they know they have to get, they didn't know the numbers there. Because I'm willing to bet most of the employees that are in age 16 need to be in the 401A. They're not, and there's a lot of them that's not in it, but it's because of the messaging that we're sending to the members. So, okay. So I'll just think that we just for education committee and we'll bring it back and then if we had it, we get to it. Oh, that includes the, oh no, that's something different. I'm sorry. I'm talking about, yeah, the hall. That's just permission.
Oh, I'm gonna say, yeah.
Yeah, I know.
It's not really like a real hat.
Try saying no, see what happens.
Yeah.
At the last meeting, we brought up, no, I'm sorry, that's not. I brought up to Chris and them that it came to Brian and our attention that members are being denied access to the loan process if they only have the raw product. So, and it's being told that by law, they can't get a loan if they only had the raw product. They have to have the pre-tax account as well. So they have to have the non-raw and the raw in order to request a loan throughout the city. All right. So the answer I got back was that it was because that's the way we developed it when we created the raw. I don't remember that. I don't ever remember saying that members couldn't borrow off the money if they only had raw. Do you remember that?
No, I think that was developed before we had a Roth option. I think it was missed, is my opinion. We're gonna find out
You
soon.
mean the loan process?
Yeah,
So the loan process was developed when we did deferred copy, when we took over, then we developed loan. Then later on down the line, when we switched to Nationwide, the Nationwide was able to give us the raw product.
Especially April of 2019.
Right.
I just think we have never looked back. Now the Roth balances, we're pushing Roth pretty hard in this city. I think that's now coming to light. The folks who only have Roth, we're just finding out. We may have just overlooked it, I think, and I won't put words
Now,
in
this
this
was
mouth.
was not told, because when it was developed, that was something that wasn't told to us, was explained to us that we need to add that into our.
Yeah, I'd like to
Got
see
it.
it. I think you're working.
Got it.
So the loan document or loan policy that we signed back
2019.
pre-2019, because we didn't have Roth, said would only access loans from pre-tax income.
Okay,
That's essentially that.
okay.
So it needs to be updated, which is a very simple thing. Add pre and post-tax or pre and Roth dollars. The only thing we asked when this issue was brought up was, we just want to look at it as a staff and make sure that there aren't any other good reasons to restrict it to only the pre-tax. And I say that because the initial data we got back from Nationwide is that extremely small percentage of both their public and private plans allow Roth. 99 Roth loans, like 99% do not. We want to understand if there are good legal or tax or policy reasons why that can be done. If there aren't, then we're happy to come back in December and say, we want to change it, or sign the form. We just didn't want to rush into it when we saw this data that part, I think it was 0.06%. I mean, it's microscopic of the amount of plans that allow. I just wanted to be cautious before changing that form, coming back to the board and making a recommendation. I don't see any reason why we can't do that at the December meeting. We just wanted a little time to make sure we understood why hardly any other plans were allowed before we recommended to you that you do.
So, well, I think we need to talk to Christina, because that's not my understanding. I may have, because according to her, is our escrow. So I just want to make sure that it's not, and maybe that's we're getting it clear messaging. So we need to change it, then let's change it, because some people we're pushing the wall. And I want to push a product, and then a member is isolated from getting the benefits that are being done on the other side. So if that's the case, but again, that's going to come from the education, because there's some other stuff that we need to bring up in the law, because it's also tax issue that is associated with the law on the other side when you withdraw.
So the good news is that we can do it, where our system is set up to have a Roth loan.
Okay.
And we did share with Chris, the number of plans that are under payroll deduction, that they do offer. There's only 16 plans that will be serviced, but then between private and public sector overall, it's less than 1%, as Chris mentioned. A few things. Currently, when we did establish the loan, when someone does loan modeling to evaluate how much loan dollars they can take out, we look at pre-tax as well as the Roth money source to permit the loan amount. However, the loan repayment goes into pre-tax. If the board approves offering Roth dollars out of the money source they currently have, we have the capability. There will be education, and again, the repayment would then be, we would distribute the dollars out based on the raw cost basis, and we can go through all of that as to how the dollars would be applied accordingly. But our system can track all of that, because Roth comes with, and currently, as you can see, the Roth contributions are increasing. So a few years ago, that was not the case. So now, if someone is 100% in Roth, and if they want a loan out, we certainly can establish that and update. But as Chris mentioned, weighing the pros and cons and understanding the full detail of when someone picks distribution, the impact aspect, participants need to be aware of that. And then you do have defaults. Currently, if someone defaults from a pre-tax repayment loan, they get a 1099-R, and it's counted as distribution fully as ordinary.
With Roth, it's a little bit different, so we can go through all of that with staff and provide and educate on all the options, so you are aware to make and empower on the decisions led to make.
To examine that, like something will have to happen with the system, like right now, when you take out a loan, it's pre-tax dollars. But if you take out a loan with a Roth, if you're just 100% Roth, it would have to be after tax.
It's always, the loans are always paid with after-tax dollars, but that's through payroll deduction. So there's not a lot of weight on one Philly system. They're just gonna send us the dollars. It will be our repeating system that will apply the repayment dollars from a Roth to the right sources, right? Because there's principal basis for qualified and non-qualified earnings. So we calculate all of that, and we certainly have the capability to do that.
So the repayment is after tax?
Always,
Always.
always. Yeah, so we can explain all the information so that at the next meeting, we have the details. And sometimes people,
Say, I just want to clarify that. Even for non-law,
yeah, and sometimes you have individuals that also have pre-tax and Roth combined, so when they request a loan, we would have to determine proportionally how those dollars would be paid out. But we do have the capabilities, the good news.
When this was brought up, I think Monday, or it came to my attention. If I hadn't seen, or we hadn't seen the stats for nationwide, that it was 99% not allowing it, I probably would have been prepared to come in pretty quickly instead of getting wrong. Those stats were pretty jarring to see that part of the other things too. And I didn't want to make a recommendation more quickly without making sure that you all had the information we needed to make the right decision. But I'm confident that next December 2nd meeting, and I can update everyone, staff can update everyone. As before December, but I didn't want to rush into that. And see how that.
Yeah, makes sense.
December's fine. Another question, I know the board said, but do y'all do a newsletter?
I'm sorry?
Do you do a newsletter, like to employees or?
We don't do a newsletter per se. I know the city does. There's a fall newsletter where we did submit information. However, we do the participant engagement program, which the trustees are. And monthly emails are going out to educate individuals. In October, there'll be email communication around cybersecurity awareness. In November, it'll be around learning more about their retirement plan that they need to be aware of. And then in December, it will be the IRS limits, the communication, the new limits for 2026 that will go out.
it's being provided us with the art that's being included in the newsletter.
Oh,
The newsletter's ready, we're waiting for the election.
yeah, okay.
There's an election.
Well, you got it down here.
So the other thing I'm thinking about is perhaps we could also have the newsletter uploaded on the various union benefit platforms. That would be another way to share the information. So all of the unions have a platform. And so where you have the various benefit information, that would be at second place. And especially since open enrollment's coming up for everyone, that would be a great place to place that information. So maybe that's another opportunity for us to educate and improve pension literacy.
Thank you. I'll pass it on to Matt to discuss the service activity.
Yeah, good morning, everybody. Just an update for September for service activity. 20 group workshops, including virtual and in-person. Total attendees, 822. That would be an increase from August. In August, Don, our CFP, does the Wednesday webinars. He was on vacation for a few weeks. And then we also, just through the process of trying to learn all the things that Brad knew, we discovered that he's controlled kind of the distribution of those webinars. So in partnership with staff and HR, we've been able to kind of get that distribution back up and running, which is why at the bottom right of the page, you'll see his CFP webinars down a little to start September, but by the end, we've got that back up. Again, thanks to everybody involved here for helping out with that. And we'll see an even further increase in October with the better kind of distribution of those marketing of those events New employee orientations, 293 participants. That was up 14 from the prior month. 252 attendees of the new employee orientations were not already enrolled in the plan. That was up 28 from the prior month. But I want to call out, we had 132 enrollments at those new employee orientations, about a 30% increase from the prior month. So thanks for everybody's partnership and allowing Sean and Christina to be on site to educate the employees, and for those for showing up and helping out those meetings as well. So that's our update for service. Any questions or comments that you have to take?
That you'll be joining us for a seminar at the FOP and whatever they can.
Yeah, we will be there on the 18th on the FOP. Bina and the team at our local office have been bringing me up to speed on what that event entails. We'll make sure that we show up and present as we always have when we're having this here.
Great, thank you.
Yeah, thanks, Rob. So we have, one investment recommendation. For this one, we'll have one next one as well. But you may recall at our first meeting in September 4th, the board accepted staff's recommendation to place the advanced small cap fund. We noted in our report at the time that recent performance had trailed the benchmark, ranking in the third quartile for the 3 years, bottom over 5 years. But we had noted that, just 6 months prior, the manager ranked much better. And we believe that the fund, warranted close monitoring, but we would come back to the table, sooner if it didn't improve. By the second quarter performance there, unfortunately, as we note, performance continued to deteriorate somewhat substantially. And we saw that competitor funds were performing significantly better, particularly here. Given that, and the time that it would take to notify members of the change, as well as, make those things on a nationwide platform, we wanted to bring this matter to your attention immediately. So we're recommending that this fund be removed from the lineup, and we map everything over to the mid cap index. We will return at a future meeting to discuss with the trustees whether or not we believe there is a different active management choice that was appropriate, or whether we could not be thought from that cap space with officials. The board accepts staff's recommendation. Members will be notified about this in the next several weeks with the assets active and to the bank government next fund.
That happens fairly quickly.
Happy to take questions, but otherwise we would. If the board wishes to do this, we
There, any questions? Motion?
Motion for staff to proceed with, recommendation of replacing the event.
There, a second? Second. All those in favor? Aye. Opposed? Thank you. Motion carried. Thank you very much. Any do this? I think we covered the. Go for this. You think return, we return. We'll go right into that. Thank you very much. Thank you. First item is approval of September 25th. Is there a motion? The moving probably seconded. All those in favor? Opposed? Any abstention? Motion carried. I think it's standard two, it's a private market.
Thanks, Rob. Adele and Chad are going to come up and walk through the report and answer initial questions. Thomas Donzia, the manager that we have partnered with in the past. One time, their returns year to date, or since we invest with them, are very impressive. This time, they're a description of the investment fund. They're here to present. I'll let these two folks walk through the report.
So, we'll just take a couple minutes just to go through
Stars is a minority owned firm, headquartered in Scottsdale, Arizona, office here. So the firm invests within the U.S. North market, targeting businesses across the area. Asset management, wealth management, business services. Typically, it targets companies with EBITDA between 5 million to 50 million. Generally, those businesses have a system of distributed scale with market opportunities. It invests anywhere between 20 to 70 million per deal. Back in 2020, we committed $25 million to Stasia Manto, which is the vintage 2018. We contributed $22 million to fund, and it returned a little over $29 million so far. It invested across 8 portfolio companies and made 8 monetization. Overall, it generated 25% IRR so far. It has currently over 143 million of unrealized value across 8 portfolio companies. So the performance is listed on page 3 of the staff report. There's a chart that offers more detail on that. So we're recommending 25 million to Stasia Fund 3 and 25 million to a sidecar with no fee or carry. So we bring the blended total fee to 1.8 or 8% with the carry 10%. GP is rating 350 million to 450 million per job. So far, they raised 183 million plus 120 million of co-investments. The fund will invest across 8 portfolio companies within the lower middle market across 3 verticals: asset management, wealth management, and business services. Basically, the same strategy as Fund 1 and 2. Again, we're recommending 25 million to Fund 3 and 25 million to sidecar.
Let's talk a little bit. You talked about the blended fees, and you know a little bit how sensitive that is to the amount of the co-investment.
The blended fee, yes, if the amount of investment raised 25 million is fully utilized, that will lower the blended fee to what I mentioned earlier. However, if it hasn't been used completely, that will affect the fee, obviously. But based on Stasia's pipeline and fund that the firms that we have their list, I believe they will hit that mark.
So I'll just weigh in there a little bit. The target is up to the 25 million. Right?
Yeah.
But the fund itself is partially seasoned. It's a good bit of transparency into what's in the fund today. Accounts looks like it's off to a really good start. All of those deals to date have had co-investment attached to it. It's dependent on deal flow going forward. So if the next 4 deals have sizable co-investment, that should get you close to, but yeah, that's not guaranteed. And we'd much prefer them not be too concentrated, not put everything in 1 or 2 deals and be more diversified. So it'll depend a little bit about the deal flow.
But the fundraising is the co-investment.
Yeah.
Then we'll
So it'll sort of go up 25% of that difference between the 2 to the 1.08. And that 1.08 assumes it exits along the way, so it's sort of modeled into the all-in fee. But if you go from 2 to 1, then just to make the math easy, then you kind of go somewhere between. They don't deploy skills. Exactly. Yeah. Direction will be the same thing. Yeah, there's a little bit of dependence on timing, exits, and all-in fees, but margin is how
In the staff report, I think about interesting discussion about the possibility of not reaching its target. Similar size venues were expected to be difficulties reaching their targets. Our carry report, you say it's possible that it's not fully invested 25 million in the co-investment side. Just talk about a little bit.
Yeah.
When you say it's possible, enlighten us a little bit more on why you think it's possible.
Specifically tied to the co-investment or the fundraise as a whole?
You said
the co-investment specifically, again,
but if you get broader, probably.
Yeah, no, the comment there is specifically tied to the fund is half invested at this point. If the commitment was being made prior to the last 4 deals, all of which had co-investment, then you have full confidence that full 25 million would work. They basically have slots for 4 or 5 maybe 6 more deals, that's what's tied to that, not necessarily deploying the full 25 million call investment. So it's more about that than the target fundraiser or anything like that. It's not such
It's not, this is a good jump for it. To a higher.
The fund size.
Yeah.
It's a larger fund than the prior. If you look at the all-in deployment for Fund 2, including the LP co-invest, it's not a massive jump. It's still right in the wheelhouse. We're not seeing them go up market. Types of deals we're looking at. So
240 to 350.
to 350 for the target. Yes, exactly.
I don't know.
On a percentage basis, larger. Yeah, I would say that's still scalable.
Some funds we see are in niche, and it's difficult. I'm
Absolutely.
not saying it's astonishing, I'm saying, Jeff, do you have any concerns about that with that?
So I would say it's generally been a more challenging fundraising environment for private equity. Smaller firms generally take longer to fundraise, so that is all true. You look at what they've closed today, and their presentation actually showed 190 versus the number that we quoted of 183. And then in their pipeline for what they expect to close in here at the end of October and December, and that should put them over 300 million based on, assuming that.
That's
they close. And that's what Solid Circle, so it's never finalized until all the docs are signed, sealed, and delivered. So
we be considered a soft circle.
Yes.
Because the board hasn't.
yes, that's what's factored into that. That's exactly right. So until it's all final, said and done. Again, I think there's one commitment that is approved, just waiting for the next close to do it together. But I'm confident they'll cross that 300 million. That's reasonably sized to deploy the strategy, even if they don't hit the 350 target. But I do think that they expect to get that target. So it doesn't give me any concern.
Just add to Chad's point, I think add to the investments we've seen with the funds here over the years is that they do a lot of investment in technology companies. And what's it's not really going to require, adapting to softwares and or investing, upgrading their systems, and that offer them a lot of opportunities to do add-ons. We see with Fund 2, they did about 8 add-ons, which Fund 1 they did about 11 add-ons. So there's a lot of opportunities that you're going to invest in.
And you also found that Fund 1 didn't perform well.
Yeah.
But based on Fund 2, you think they learned lessons. Can you just go through what you think they learned?
Yeah. With the you talk about emerging firms or newer firms, Fund 1, there's always risks that what they thought they would be able to do. There's lessons learned along the way, and maybe it doesn't come to fruition. I think they've learned a number of lessons. You can see that in the way they've structured the firm, the way they've changed the mandates to ensure it's profitable businesses that they're going into, not getting into deals too early that take a longer time. They did some of those in Fund 1. You can see that the performance track record Fund 2 is much stronger. Fund 3 looks like it's off to the same start. So it's natural risk that comes with doing a Fund 1 or a Fund 2. But you want to see them learn from those lessons. Everyone's going to make mistakes. You want them to learn from those lessons and build upon that. And I think we're seeing that consistently happen here as they've institutionalized the firm, their process, the resources and the team around them have all moved in the direction that we want to see as they build their business and institutionalize.
I have a great question, very quick. The net IRR, you may have just answered it, just from Fund 1, 6.9 to 25%.
Yep.
They got that much better what they did.
So in Fund 2, they've done a much better job of. So Fund 1, a few of the deals that they got into were earlier stage, less developed than the Fund 2 deals. But it's taken them longer to realize the value they thought they would. Not necessarily that they were bad businesses or started to lose money, just longer to get there. So that'll weigh on there. Fund 2, they've been much better. These are businesses that are more established, develop EBITDA levels that are growing from there. So it's a better starting point. That's helped firm that up. And then they had a really strong exit with R&T, which is so that's the other firm that's discussion. They think they have the UK equivalent to that in Fund 3, which we've had exposure to. That's driven that number. It's been a really successful exit for them. So they have done a really nice job, but there's a couple of reasons for that. It's competitive.
And you're seeing the same approach.
Same approach, very consistent there too. That's great.
Challenge environment, fundraising, utilities, money, issues.
So
Yes, that's for the front.
You all have done a very nice job. You guys have all done a really nice job of negotiating, co-invested vehicles, things like that. It breaks along the way. The way that they set it up for this fund is if you were to do a larger commitment into the fund, you could get a discount there, as opposed to the way you're doing it at 25 and the 25 co-investment. I think it's a more effective way to bring down fees.
Is there a way to have some reduction based on investment outcome?
That's a question I maybe reserved asked that maybe.
Twenty-five.
That's a question I asked them. Again, like what's written into their docs, what they agreed to, also with side letters, and everything. That would probably play a question.
They're looking for agreement. Great, thanks. Who's they bring in?
Got it.
Okay, we'll finish up for you back.
That's great. That is perfect.
All those in favor?
How did I vote?
Right here.
Okay. We'll check.
Right next to you. Hey,
Hello. Thank you.
hello, everybody.
Thank you for having us. Whenever you're ready. Okay. Well, I do want to thank everyone for having us here today. It's a great privilege and pleasure.
No, I thought they were supposed to get something, but you got 20 minutes. I thought the staff would do this, but it's fine. I'm good. I got the clock.
What we'd like to do is set an agenda, and we're going to cover a couple things. So introduce ourselves, talk to you about our overview of what we do, our commitment to the city, an update on the investments that you have already entrusted us with money, give you an overview of how that has turned out. And then I know you're evaluating us for Fund 3 and what we've already done in that fund and what you'll step into as a result of that if you approve to invest with us. So those are the 5 topics we'll touch on today. I think it's really important to get to know who we are a little bit. We've done this before because the last time you invested with us, it was COVID. So we're very pleased to be here. So Marty, do you want to introduce yourself?
Yeah, so I'm Marty DePiece. I'm an MD here at Estancia and the head of investor relations and fundraising. And I've been with the firm for about 7.5 years. And prior to that, I spent most of my career raising capital for every type of private and public type of investment vehicle you can imagine. And I'm also a proud graduate of
And my name is Takashi Moriuchi. I'm co-founder of the firm. We started the business back in March of 2010. I think my family, and it's important, as I said earlier, that you get to know who we are as people. I think my family is a great example of what Philadelphia has to offer. So on my mom's side, a multi-generation Philadelphia family. Grandfather grew up in West Philadelphia, went to Penn. Those who are enough to remember, became a reporter and then ultimately an editor at the Bulletin. On my dad's side, on the Japanese American side, they were interned and the Quaker community here was very important and brought them here to restart their lives. Fast forward, my family and I started, my wife and I started a family in Fairmount. She is now a professor at LaSalle University. My 2 kids I went to Germantown Friends. I've been a board member there for a decade now. And my 2 kids, I'm happy to say, one is graduated from Penn and the other is a sophomore at Penn. So we're very, very proud that we are here to present to you. This is personal. And we're just very fortunate that you have agreed to be with us and trust us with your capital.
So do you mind?
Yeah, so, we have presentations for you all, and we don't have to even open them up or anything. But as the copy said, we just wanted to tell you a little bit about what we invest in and how we do it, and then we'll get into some of the other details. But what's important about Estancia and what we invest in is it's companies that provide what we call mission critical solutions to the financial system. The most simple way to think about it is it's the pipes and the plumbing of the financial system. So things like data analytics, things like fund administration, back office technology, anything that helps cash move between banks safely and securely, that's the kind of stuff we invest in. What we don't invest in, I think this is equally as important, is we don't invest in banks or insurance companies. So the businesses we like tend to have high recurring revenues, a sticky client base that always comes back, high gross margins at scale, and typically they have an untapped growing market. And I think, you know, as you think about why is that such an interesting place to invest, it's because the financial services world is vast. It's trillions of dollars. There's a tremendous amount of money that goes into it, but very little money, very, very little that comes in at the lower middle market, which is where we invest. And that allows us to find opportunities that wouldn't be big enough for some, they wouldn't be obvious to others who are not sector specialists. And it provides an opportunity to buy and invest alongside management in businesses that others might not even understand or know exist. And also the valuation that's with which we can get returns. I just want to end by saying what I think is also important about this pipes and plumbing is it allows us to find opportunities, as I said, that might not be immediately obvious, but also bring companies together. And, you know, that in that way, we can find companies to find new sources of revenues and even uncover new businesses. So a lot of the kind of investments we find tend to be what we call proprietary. They're non-bank. Again, you're not in an auction process. You're not going to the highest bidder. And then the final thing I'll say about this is because we're a team that comes with decades of experience in investing and operating businesses on our own, management's really like working with us. They see us as real partners because we understand not only the opportunity, but the challenges that they face. So let me leave it at that in terms of some of the big picture stuff we do and turn it over to Victor to talk more about the team and how we do what we do.
So on page 4, you will notice we have highlighted we're a team of 15. If you go back to when we originally started, there were 3 of us. We are now 15 full-time employees. And in 2022, we made a commitment to the city. The reason that we decided to open our second office in our small business in South Arizona, our co-partner, co-founder is for the location. It's a great location. It's very central from a transportation standpoint. You have a lot of the opportunity to look at it up in New York City and areas so people get on the trains. People come visit us, investors come visit us. Then importantly, develop our staff. Younger professionals want to be in the city. Of course, we looked outside the city, but it became very clear to me that to open an office in the center city gave us that advantage. I expect that as the
Still a lot of your opportunities in New York.
yes, yeah. So we actually have looked at things here as well. We look nationally,
yeah,
but there are things that there are companies here that we've looked at all over. But because of the vertical, we look at financial services a lot. Also,
I'm sure. Yeah,
but we are actively looking here in Philadelphia as well. Just actually, we looked at something that was not in Center City, but it's Philadelphia Metro. So just to give you a sense of that, we are committed to the city, and we're going to continue to expand our office so that we go in right on Lincoln Square. So the next page, which I think is what I know my firm and I are most proud about, is what we've done for you so far. So at the top, you see 3 lines. You have invested in us in our second fund, and you did that back in 2020. You can see you committed $25 million. There is still $15.2 million of unrealized valuation, and that's only going to continue to expand. I'll explain why in a minute.
We have realized almost $30 million already. And together, those two numbers represent what the total returns are. That has generated net of fees over 2 times for you and a 30% IRR. We have to deliver those types of numbers, but that's very hard to do. I think you all probably have seen lots of different managers. That's a hard thing to do. Our goal is to deliver to you next 2.5 times MOIC, return on capital, 2.5 times. Whatever you give us, that's what we're able to deliver back to you for each fund, net of fees. You also invested along, the staff also agreed and selected one of our investments as a co-investment. We agreed to do that on a no fee, no carry basis, so basically fee free, because of the relationship that we have with the staff. You invested $5 million in one of our portfolio companies called PMA Financial. That was a family-owned business that managed, when we founded, about $20 billion of school district and municipality money nationally, and we helped them expand and grow and made that investment into over almost 3.5 times net of the return. So, and that has largely been realized. We sold that company about 1.5 years ago. We kept a small piece because we know it's going to continue to grow. So we wanted to keep a little bit more to continue to compound returns. So on a blended basis for Fund 2, you allocated to us $30 million, and you have about $62 million return for a net of about 2.4 times cash return. However, in Fund 2, we still have 5 positions, 5 companies that we own, and they are all trending very well. So I expect when we're sitting here again, hopefully in a year or two, you'll see that we return north of 3 times net of fees for you all as a result of that, which is without much hard to do, but we will do that for you. As a result of the relationship that we have with the staff, and they have explained to us how important partnering with managers that understand the fees that the city of Philadelphia is paying. We've agreed to what I think is a pretty unique structure here. You are considering to allocate to us $25 million at a full fee. But then we've also agreed to take on $25 million co-investment, and we'll do that for no fees at all. So when that happens and we pull all that money, so that what that means is when we find our next investment, you'll give us, we'll look at the allocation, you'll give us I'll be able to call $5 million or $3 million from the fee paying side, and then also say to Chris and team, do you want to come into this investment? And most likely they'll say yes, and they'll contribute another 3 on the carry investment from a co-investment standpoint, and that will come in at no fee and no carry. So when that happens, your fees will blend down to basically half the cost of what if you just came in to the primary vehicle at a full fee level. Yes.
I guess a couple of questions.
Yes.
We really appreciate that you're willing to
yes
look at the and talk to us about that. How confident are you to get that co-investment?
Yes, so we have a great deal of money still put to work. If you go to the next page, and this is the last topic I want to touch on, we have already been investing out of Fund 3, again, the fund you're evaluating us for. So when you step into that fund, it has already experienced some value creation. That is, we basically returned it. We're from a mark standpoint, we're up about 10%. So you will come in at cost, but you will immediately get that benefits. The reason I'm mentioning that is in addition to the fund, we have also called co-investment of about the same size of what the fund has put to work so far across these 4 investments. So if you're looking at page 6 and you go 4 lines down, you can see the 3 lines down, you can see the co-investment capital that we have called for each one of those investments. So each investment has a co-investment allocation. And when we make our next investment, there'll be a co-investment allocation, and we'll be on Chris and team to say, you ultimately have to approve it, but would you like to come in? We're going to create that amount for you. So to answer your question, I have a high degree of confidence you're going to be able to put that to work. We're a small firm. We need as much capital as we can to complete our investments. And it actually helps us quite a bit to know that we have a dedicated co-investment pool of assets because it gives us high degree of confidence that we will show up with the capital when we close the investment.
So in the unlikely event we didn't invest
would you be willing to look again? 220 is high for us, and we're getting the blended rate, which is great, but there's some risk for us, right, that won't come through.
Yeah, so on that, and I'm always open to talking about things, but I'm highly confident. So we actually have an investment we're looking at right now that requires co-investment. So I really don't think this is going to be an issue.
So you're willing to talk about it.
I'm willing to. So
Those first two investments on page 6.
yes, sir.
Who is making the co-investment? Why is the co-investment higher than the initial capital? Are there companies that aren't making the initial investment, giving the opportunity to make the co-investment, or are companies that are rewarding for the co-investment?
So we'll use Flagstone as an example. There's a whole reason why we invested in this business. We think about first from the fund size. Our ultimate fund will be $350 million. And I want to make sure that from an allocation standpoint, we're not over allocated. So we first start with, you would be giving us money and be in that fund. I first think about when we make an initial investment in the company, at the most, we may take a 15% position. So roughly $50 million of the fund to start that position. That business, when we found it, and the valuation was a 300 million pound business. And so we needed to show up with almost another $100 million. We are able to, that is unusual that a company will have the confidence in a private equity firm of our size to make that size investment. But because we've been doing this for so long and our co-investment relationships are so strong, like with what you all are contemplating, we're able to show up with that amount of money from our investors. They're all limited partners. They give us co-investment. The vast majority of that money is Hamilton Lane. Just to give you a sense of who that is. It's not another company. It is our investor relationships with our investors that are coming in as a co-investor alongside us because they trust us. I would love to have that money in our fund. Don't get me wrong. But because of where we are and the size of our fund, I always need to find co-investment, which is a little stressful, but we have always done it. So I think practice.
Yeah, so people have an opportunity to invest more at co-invest.
Correct, and we give preference. Correct, and we give preference to our limited partners. So again, going back to your question, this is not going to be, my view, an issue.
Someone being co-investor and was not able.
We have used that as a way for institutional investors to get to know who we are and see how we underwrite our deals. And yes, so Hamilton Lane was not in Fund 2. They're now in Fund 3 because they co-invested into the PMA deal that you invested in. They were in that as well. And they were also in another investment called R&T Deposit Solutions. Yes. So in conclusion, all four of these companies are already in Fund 3. This is where you're coming in. I can give you some statistics. I looked at them before I arrived here. But if you are looking at the key growth metrics, all these companies have continued to grow. And unfortunately, my presentation, I put notes in, was crashed. So I'm just doing this whole from memory. But Flagstone roughly had about 50, from a revenue standpoint, was like roughly about $50 million. They are now a year and a half later on a run rate basis, almost 65 million of revenue. A good way to see this actually is if you go to page 7, which is the kind of final slide. You can see the 3 companies that have been in the portfolio when this slide was created have all been growing. So you look at the revenue and you look at Flagstone's the blue one. So 57 at our closing, they had about 57 million of revenue. And as of the end of June 30, they're now at 75 million. So you get the set from these, you can see the statistics, and all 3 of these companies have been doing well. And as a result, we believe there's going to continue to be increase in value because they're on their way and we'll pay for our underwriting. We're well on our way to being our underwriting goals. Again, that kind of nets you guys 2.5 times cash flow and cash return net earnings. Okay.
And I would also just take a note on that too, on how these companies have been performing. So we invested in those 3 companies a year ago. And what we like to do when we get involved in a company is, maybe we bring in additional personnel if they need it. Maybe we have to add more salespeople. Maybe we have to spend money on technology. So what's really exciting to me is that already you're starting to see fruits of that labor, but you're not even only a full year into getting the benefits of a lot of that. So the momentum from this very strong high-end, revenue growth, as well as EBITDA starting to pick up, is really exciting because we're just at the tip of the iceberg.
So I know we're close to the end, so I will include our comments, but if you have questions, let's.
Can you talk a little bit about what happened one or learn?
Yes.
Showing up to it.
So Fund One, my co-founder and I are come from an operating background, and we were getting the business off the ground. It was much smaller, it was $180 million, but we were trying to get into business and invest along the way. The biggest lesson learned, if there's just one lesson I had to learn, it was we have to invest in companies that have 10 million of EBITDA or more, five at the lowest amount. Almost all the companies in Fund One were either losing money or were break even. And this goes back to what Marty just said. Our playbook is when we make that investment and close the deal, we have a list of things we're going to do immediately that will increase the expenses at the firm. And then 2-3 years later, you start to see the cash flow, the cash generation expand as a result of that investment. When you're doing that in companies that are losing money, any dollars that you make, you put right back into the business, and it takes a lot longer to get there. I'm happy to report the companies, if you look at how they ended up, they're all generating a lot more earnings than we found, and all positive. In some instances, like Snowden, which is our biggest position, that was losing $5 million when we made the investment, is now generating about 22 million of earnings. So, but it just took way too long. And so when we look at how we're going to be compared, Marquette's going to look at us and say, we can't take that long. We have to do it in 5 years. And that's why you've seen a big change in Fund 2 and performance, and what is also happening now in Fund 3, specifically within a year and a half of making our initial investment. So that was the biggest lesson learned, which is, trust me, we've learned the amount of time we spent with our Fund 1 companies, we should be generating a 10 times return. So.
Touched on the one, the fee level you're at, the performance of Fund One would cut, not in this space.
Correct.
You seem confident that Fund Two is more the model, and you're softly promising more than that. Great.
That's right.
Okay. Take that up to Chris, but again,
yeah,
you focused on Fund Two, which I would have done too if I was.
We're not Blackstone, we're not established.
Another concern with staff point is highly concentrated. Financial service.
What happens to your fund if that turbulence, which we've seen in the past, right? What happens then?
Well, I would tell you, as I look through this, let me just look real quick. If you look at Fund 2, RT was in New York. Oh, sorry, I'm back on page 17. North Square, so starting at the top, North Square is in Chicago and Pittsburgh. Geneva is in Milwaukee. Investor Com is in Toronto. Strategy Corp is in Nashville. Soltis is in St. George, Utah. RT is in New York City. Cable Noser was in New York City. And PMA is in Naperville. So just to let you know, again, we are a national firm. We invest nationally. A lot of the meetings, a lot of conference, the proximity build up to New York is really good because it's the industry focus on. But as you can tell, most of our investments are outside New
York. Anything else?
Any more questions?
Thank you. Anything else? And thanks very much.
And the fee schedule is still open for negotiation.
Yeah.
Right.
Yeah.
Okay. That's it? That's it?
Thank you, everybody.
Thank you. Thank you.
Thank you, everybody.
Yeah.
Any discussion, any questions? No discussion or questions, is there a motion?
I'll make the motion, I'll make that recommendation. No, good. I'm at it. But I think staff recommendation.
All those in favor?
Aye.
Those opposed, any attention, motion carried. Thank you very much. That was impressive.
It was.
Yeah. Okay. Next, the name?
Yeah.
Aaron, how are you?
Wonderful.
Great. Any questions, question?
Yes.
Okay.
So staff and Marquette are bringing a new firm recommendation to the board. Pressing, credit management, capital. Their firm has been around for 34 years. Founded in 1991, 225 employees, 5 offices, headquartered in Boston. They're a wholly owned subsidiary. I'm just going to spend 30 seconds because I think it's important. Wholly owned subsidiary, Sun Life Financial, which is one of the largest publicly traded companies in Canada, insurance company, investment grade, stellar credit, fiscally sound parent company with 1.5 trillion of Canadian dollars, 1.1 trillion of US dollars under management. Crescent Capital is a wholly owned subsidiary, 51% right now, majority owned. Probably by the end of 2026, fully owned or close it.
It'll probably be early.
Okay, so it'll be 100% owned by 2026. What that means for us, Crescent, which currently has about 48 billion in management, will be backed by a firm that has 1.1 trillion and is ultra conservative. So that is a very reassuring thing to know in this type of situation that we're in right now. Our recommendation is that we invest $15 million into Crescent Credit Solution 9 fund in the main fund with a $15 million investment, co-investment sidecar at no fee, no carry for $30 million total investment. Here are the important points I just want to point out to the board. There are 2 funds that they have. They have a main fund and they have a senior owned. Staff and Marquette are only recommending invest in the senior owned fund. Reason being, it is first in line up here in terms of the credit, the investments. And if anything were to happen, not to say that we will, but you always have to the downside, we're first in line to get our money back. So it's senior secured. Also, Chris, Chad, myself, and everyone else will recommend unlevered fund. So we're trying to minimize our risk, but also get a above market return. Historically, if you take a look back through previous funds, their target numbers have been very impressive. This fund is targeting a 9 to 11% total return. It's currently yielding 13%. From what our previous had on, we're based upon cash flow. We have to pay out $62 million every month in benefits. We're able to get a 13% yield that's currently yield on the fund. This fund, they're looking to raise $5 billion or 3.8 billion. It's private credit right now is people are being cautious. So we're being ultra cautious so far as our recommendation. This will take us, if it's right, we're looking at about a 2% allocation for the fund overall towards private credit. This will put us right at that point. Fully diversified portfolio and a very, very stable track record.
let me get into the fees. With the senior only, we're looking at 85 basis points for the management fee. Get a 10% basis point reduction because we're closing, we're part of the 2 billion close. That's 75 basis points, sorry. No fee, no carry. We're able to bring that down to approximately 35 basis points and a 5% carry and a 6% hurdle. I've been here 9.5 years now. I think this may be the best fee on a risk reward basis that we've made. I mean, it's very competitive. Very competitive. So we feel very confident this manager outside, and also Eric Hall, is the managing director of investment related. We have a long-standing relationship with him from his previous firm. So he's the chair of NASP, actually. And Joe Kaufman is the portfolio manager who's been brought in, the partner who's been brought in. In the report, we had mentioned that Crescent Capital, and we just discussed it, is being, they're being bought out by Sun Life. There is a transition there that the board is, the team staff here are fully aware of, and we're very confident in that bench that they have in terms of the people that.
Well, it's kind of like, there's a kind of basically the pre-meeting that those two folks who are retired will still be active. Right. Still have their service.
Yes.
Yeah, they will remain on the investment committee through the investment period for this funds. Even though they started to step back from some of the like leadership functions after prior, they're still doing some care about. Yeah, and it's still one thought that it's sort of by your plan, but it's
Couple of Main Street staff would preferred return. Is it 6%? 6% immediately take.
In this case,
why?
So the reason that 6% is because you're doing the senior only, more conservative structure, and then unlevered on top of that. Yeah, the range we see is 5 to 8%. You're not seeing too many funds at 5% level anymore, especially as rates are higher than they have been. That's function. Achieving a higher hurdle rate is something that firms are committing to more. And again, this is top of the capital structure, more senior, hopefully lower risk, lower downside, and therefore the hurdle rates commensurate with that.
I guess like the game where you show 4 times 12 and so taking that after really blow you away.
Yeah, so it's sort of middle of fairway. Again, generally a more conservative posturing, but not expecting them to deliver 20% IRR type return. Again, I think it took a long time, but cautious with the fourth year, with a focus on the downside as a major priority. So again, I think it's sort of in the middle of the fairway. Generally have done a good job on the downside from a loss perspective. So we're trying to help with that.
Any other questions for you? Yeah, so the firm is being bought out by Sun Life. So does that make it now a Canadian based firm?
So the parent will, yes, be Canadian based. They're a subsidiary, so they'll be able to maintain that US structure as Crescent, but the ultimate parent is Canadian based.
Crescent will remain American.
Yes.
Based, American operated, American tax paid.
And that's, as Brian stated about New York, that's not going to have any implications on the tariff stuff that is happening between Canada and the United States.
The vast majority of the deal flow that they're doing is all US based. So that case, that risk mitigates or eliminates that.
And during the succession period, once they take over and the two co-owners, how much voting power would they have? The two guys. How much voting power would they have once Sun takes over?
So they'll maintain the same structure for the investment committee. It's a majority approval process, so they will have a right to vote or veto. So it'll be unchanged essentially for this fund specifically. Sort of after that period, we expect them to retire. It's a bad period. They're mid-60s, both of them. But for this fund, it's unchanged as they assume full ownership. Right now, they have the 51% ownership of Crescent. That becomes 100%, which was negotiated 5 years ago in the deal.
So it's not set up where their vote is the final vote.
They're not set up that way.
Okay.
That's correct.
All right.
That's correct.
Any other questions? Again. Okay, here. 10 seconds, try. I think this will be more, but. Oh, thank you. Thank you for coming in. Definitely ready to start, although Carol, that's an instruction.
I do. You had funny.
Yeah.
Yeah.
Thank you. Now I would get it on if they want.
I'm like, they're going 20 minutes, right?
I think it is good morning still. Great to see you. Yes. Here. Thanks for the time. Thank you for the consideration. My name is Eric Hall. I am a senior client team at Crescent. I work with existing clients and prospective investors at the firm, joined by my partner, Dr. Joe Hoffman. Joe's one of the senior most investment professionals in the firm. He's been with the firm for years. Been private credit for close to 5 years. Joe works on our Crescent Credit Solution strategy, which we're going to call CCS, and that's the last acronym we're going to use. And so CCS, of course, is what we're here to talk about. To our flagship fund. So Joe's been involved in that strategy. He's going to talk about focus of the strategy, the partnership market, our process, our philosophy. We have time to do a case study to help sort of contextualize what's in the fund today. And I'm going to spend just a minute, maybe two, on the firm. And we encourage you to ask questions and interrupt us if there's something that isn't clear or there's something we haven't said. Please jump in. So page 8 is a good sort of landing page to mention the firm. It's a good snapshot of the mapping. So Crescent was founded in 1991, and our focus at the time, our focus today is exclusively corporate credit. So we don't invest in equity, either private equity or long-only equity. We don't invest in infrastructure or real estate, hedge funds. All we do is credit. Today, we're at 48 acre. That page 8, $48 billion is our AUM. 3/4 of our AUM today is in private credit. That's the strategy we're going to talk about today. So that's about $36 billion. So that is really direct lending to small and mid-sized businesses, all of which are private equity. The other quarter is $11 billion, and those are strategies you might find in your fixed income portfolio, like high yield bonds or broadly syndicated loans or collateralized loan applications. Today, Crescent has about 230 professionals across 5 offices, 4 in the US, 1 in London. The MDs at our firm are long tenured, meaning managing directors have been here 20 years at the firm, not in the business, but 20 years at the firm. So that translates into the team you meet when you provide us money to invest on your behalf is likely the team that you're going to work with winds down. And then just a quick word on philosophy. Our view is we focus on preservation of capital first and foremost, and then delivering a return in line with the risk that you take with us. Beyond. And so credit for us is a yes or no. We like to say it's binary. If it's a credit we like,
we want to own that credit. If it's a credit we don't like, there's no price or spread or yield that's going to entice us to say yes to that. And so about 30% of our assets come from insurance companies. So that should give you a sense of the type of conservative approach to the space. Last thing on the firm, of the 48 billion we manage, 12 billion is with U.S. pensions. So that's unions, public funds, and corporates, and about 5 billion is with public pension plans. So, any questions on precedent?
Are any concern about the merger of Iowa Sun Life and Continental?
Yeah, great question. Thank you. Our partnership with Sun Life has been signaled for the last 5 years. They own 51% of us as of today, and then in January will be 100%. They're a wonderful partner to us. They provide catalytic seed capital for funds that we launch. But outside of that, they are hands off. So all of our investment processes, all of our operational processes, our management team is separate and apart, and they don't get involved in day to day.
Would be a separate corporate structure as a subsidiary, or?
Yes, we're an affiliate of Sun Life. We sit alongside a couple of other affiliates, one of which is MFS. You may know MFS has been around a long time. Most people don't know MFS is an affiliate that's owned by Sun Life. So it's that kind of a passive relationship, but the capital they provide again can help us launch strategies. Thank you for the question. Okay, so let's turn to CCS, where we're in the market with our 9th vintage. It's been around since 1992. We're excited to talk about the opportunities out there. Turn to Chairman, please.
Okay. Yeah, so Eric, and you know, who we are at Crescent. With CCS, the way you should think about us, we are a direct lender to U.S. sponsor-backed companies in the core middle market. And all those pieces are important. Private debt, private credit means a lot of things, different things to different people. But we are focused on this core middle market, and I think maybe just makes sense. Jump to page 18, to kind of lay out the competitive landscape. I'm sure you have a lot of that here. We think about the market. We don't have it on here, but really kind of lower core and upper. Lower, these are smaller businesses. The lending landscape is very fragmented. There are a lot of players. Because the companies are smaller, they may have geographic limitations, some customer concentration. So generally puts less leverage on, and that also means lower returns. At the upper end, these are much larger businesses, and when you're lending, you're really competing more with banks. So there's a lot of pressure on pricing, a lot of pressure on terms. You're really competing kind of with a public option, whereas we're private. And then we also have in that end of the market is when you have a $4 or $5 billion deal, you're going to have the same 10, 15, 20 lenders in most of those deals. So their portfolios all start to look very similar. They all have exposure to the same assets. Core middle market, which we define as 50 to 100 million EBITDA or capital, it's a little bit kind of like the Goldilocks, not too big, not too small, in that we can be very relevant to these companies. They're still large companies, and we can define it as core. They've got leading market share, nice diversified operations, but really we can be very relevant. So we're going to be, sometimes we're the only lender. More often than not, we're going to be one of maybe 2, 3, 4 lenders. So when you look at our portfolio, it's very differentiated. It's very hard to replicate that. So we think we have this unique portfolio of assets. The other part is when you're part of a small group of lenders, you have a lot more control. And we are doing 2 to 3 months of due diligence. We are negotiating the credit agreements. We understand what the risks are. And if we get comfortable, as Eric said, price something attractive, we'll do the deal. If not, we'll walk away from something. It's a very wide funnel of opportunities where we review 300-400 transactions a year, and we're only going to do what we think are kind of the best 15 or 20, and we're looking to deploy the fund over a 3-year period. So there's 20 I would say the common theme, and this segues to the next page, is that they're all high cash flow businesses. We are cash flow lenders. We're looking at the underlying cash flows of the company to A, pay our interest, and B, pay back our principal when our debt matures or earlier. So, again, great segue. If we look at page 21, these are the industries that we focus on. They tend to be high cash flow. They don't require a lot of investment in main operations, things like capital expenditures. The business services, consumer services always make up a large portion of our portfolio. You should think of those companies as nice, boring businesses, commercial landscaping, fire inspection services, the companies that go to commercial buildings and inspect the sprinklers and the extinguishers, companies that monitor security alarms. So very stable businesses, and cash flows are important. The quality of cash flows very important, and then the visibility of those cash flows extremely important because we want to know when we make an investment, maybe we're in there for 2 years, maybe we're in there for 5 years. We want to know that the cash flow is going to be there. So we like recurring revenues, companies that are less cyclical, less capital intensive.
They also mature companies.
More mature companies. We don't do when we do software, when we do technology, these are large mature businesses with large installed base of customers where they just get a certain amount every year from their customers, like insurance brokerage, where every time someone pays a premium, these companies get a percentage of that. So yes, large mature businesses, but importantly, with this recurring revenue and mission critical services. So we've invested a lot in home repair, HVAC, but a lot of private equity platforms in that space where you're at home, it's 95 degrees, your air conditioning breaks, you're going to call someone to fix it. So kind of these mission critical types of products and services, and that's what we've always focused on.
What's performance in your funds?
So over our 35 years, we've delivered about a 12% net return. I would say importantly,
Needs 20.
yes, we have it on there somewhere. Importantly, but I think the key to being successful in credit is not making a lot of mistakes. So when you look at our loss ratio, literally over 35 years, it is 1/10 on an annualized basis. And that's really the key to being successful here is not making a lot of mistakes. So we spend, as I said, a lot of time analyzing these businesses. It is a very high bar. We're only funding 3 or 4% of everything that we look at every year. And that's the way we're focused on business. I think here just for a minute to sort of drive this home a little bit in what we like. On page 25, we have a case study, a company called Bonterra, and it's a software business. It was a buyout by a private equity firm called Apex, and what they provide is what they call social good software. So their customers are not-for-profits, charities, foundations, and they basically provide all the tools that these organizations use and need to manage their business. So capital campaigns, donor engagement, donor management. So it's very, very critical to the businesses. And what drove it home to me is we do all of our work. We rely on the private equity firms. They provide us with a lot of analysis. But I spoke to my wife, who chairs a not-for-profit in the city. They help women in need kind of re-enter the workforce. Problems Closet, I think their logo is on our charities page. And talked to her head of fundraising. And while they actually weren't a customer, they used a competitor. It is something that they cannot do business without. They're actually not that happy with the service, but they could never rip it out. It would be so disruptive to the business. They would lose so much information. So it kind of gets back to that mission critical nature. It's also, I think, indicative of the way we do business. We rely on the sponsors, but we've all been doing this for a long time. We'll access our own network. We'll do our own independent due diligence to try and get to the right answer for the right reason. Fund 9 today at 10 investments. We've committed about $1 billion of capital. We've got one more that should get signed up soon. So from an investment pace, I think we're right where we need to be, right where we're looking to be. The fund is generating 10% return right now. All senior loans, top of the capital structure. So very conservative. There's a lot of equity below us. And we like to be very much aligned with the private equity firms that we're partnering with. And we lead, in this case, every one of those transactions. So, very important because we're doing all primary work. And but we like to say that, the work doesn't end when you fund a deal. You need to stay very close to the operations. So we're getting quarterly reports, we're getting monthly reports. We're getting all the information that the owners are looking at to manage their business. And what that does is that allows us to stay ahead of problems. We can be very proactive. Not everything is always going to be right on budget. And if there are any issues, we can take active action early enough to be able to manage through it. And I guess back to that loss rate, because we're observation rights on a handful of our businesses. We have maintenance covenants, but it's all about just staying very close. And that's the way we've always operated our business. It's a partnership approach. We work very closely with the private equity firms, the management teams. That's why we've been able to deliver the returns that we have. And as Eric said, I've been there for 20 years. My partners have all been there for 18, 20, 24 years. A lot of the track record, but the procedures that we have in place today to manage business, this is the team that really developed that and will continue to do so.
So did you guys talk about co-investment? Well, right, because that had anything to do with page 19, like the jumbo loan management over that? When that was these two, both of them.
Yeah, so we're doing on page 19 is, what I talked about, these larger deals and a lot of our very large competitors, they've been very successful raising money in the public markets. So high net worth people, where they think billions of dollars of inflows in every quarter, sometimes every month, money needs to be put to work. So I say when there is a $4 or $5 billion loan, you're going to get all of those same competitors in there. They have to deploy that capital. So there's going to be significant overlap. They're all going to have exposure to the same deals, and that's not the market that we're in. They become the market. And we say, we are not the market. It's going to be very selective, and it's going to be just the investments that sort of meet those criteria.
You want to go with these?
Yeah.
Can we go to slide 27 again,
which is gets into your question about co-invest. So standard fees, standard terms are on the left side of the page. So with $500 target fund, the standard management fees, and the sleeve in which that's 85 basis points. There is a discount today. So on the right-hand side, you can see there's a 10 basis point what we call first mover discount. There's $2 billion in the fund, and we're about to get $2 billion mark. You qualify for that. So 75 basis points management fee at 10% carry for half of the commitment, 50 million. And then we've created a co-invest vehicle for investors like yourselves, offering co-invest on a go-fee basis. We've seen this before. So we blend together the average management fee is 3.75%, and the blended carry is 5%.
And then so you think of it, it's like we talked a bit of it.
So, satisfied.
Good question. Thank you very much. Excuse me. It was finished.
We're 17 minutes. 3 minutes, yes. Very good. Thank you so much.
You could do two, or someone else could do it.
I move we accept staff's recommendation for this investment.
Second.
All those in favor? Aye. Opposed? Any abstentions? Motion carries. So very much. So now we go to.
I'll let Dave momentarily, talk to Mackenzie, but I just wanted to review the performance. Good on seat yesterday, we emailed the estimated performance, through October 21st, which looks strong. Again, about 70 basis points, couple basis points behind the cash adjustment benchmarks, almost 5.2% fiscal year date, about 25 basis points ahead of the cash adjustment benchmark, year to date up around 13%. So, right in line with the benchmark. Last month, the time goes on pretty well. Last month was a strong month for planning. Dave will talk about, as I said, Mackenzie momentarily, up 1.2%, 10 basis points ahead of the benchmark. And when you can see all the way out to about 5 years, this plan is right in line with or slightly ahead of the benchmark. And that's spread over the long time. No actionable concerns from staff's perspective on any of the managers. Public underperformed for the month. Mara and Ernest, we're not concerned about the immediate term because we believe that we wouldn't expect to see them necessarily do well with the type of stock. So both of them, even within the growth space, we're not going to buy certain stocks with negative earnings, and that's the most part of what's been. The global involved managers, Fidelity was in line with the benchmark, MFF was ahead. The board brings some comments and recommendations on that, but we sort of the second meeting. See the quarterly returns for the open-ended real estate managers, both ahead of benchmark for the quarter, both returns 1.1%, 60 basis points ahead of the Odyssey index. So hopefully that's a sign that we're going to stabilize the commercial rates. I'm happy to take questions on any of the managers, outside of Mackenzie, or if there's any specific market commentary. I did just want to note, we do have, as of today, about $485 million in cash, and that's paying just north of 4%. So we did see what the Fed wanted to do, it's almost an immediate increase in the rate, but we are still north of 4%.
Please. All right. How much time is that?
2 minutes. Wait, good, okay, so McKinsey, we added McKinsey in 2017 as one of two international small cap managers. International small cap, like US small cap, the exhibits we describe is informational inefficiency that should allow active managers to extract value and outperform their respective indexes. It's been a challenging environment lately. McKinsey has certainly had some challenges, especially around Japanese equity. We did have 4 or 5 consecutive calendar year returns of positive experience from McKinsey, but this is an asset class that does exhibit a lot of volatility. And admittedly, there have been some significant macroeconomic and central bank shocks that perhaps caught McKinsey a little bit flat-footed, causing what I would describe as lower quality stocks to rally. It's the same phenomenon that we are experiencing in the US that we're seeing in recent McKinsey. So certainly we've had some challenges over the course of the last calendar year in 24, and so far this year, in addition to policy shocks and tariffs. This is a high quality manager, high quality companies, 70 to 100 different companies usually, and we should be able to
perform the way we would expect it to.
I would say it's performing.
Yes, there have been some exogenous factors that have made performance challenging in this space.
But nothing that causes you enough concern right now.
Yeah,
So you should keep monitoring.
Yes, I think that is a sensible.
How long gonna keep monitoring?
Well, I think that we should at least evaluate on a quarterly basis.
So we're doing the second quarter now.
I'm sorry, yeah,
We're
this
doing the
memo
second
was
quarter.
as of the second quarter, right? We have performance through the end of.
So in January, that would be the third quarter.
I mean, the only word of caution that I would offer to this is an asset class compared to some of the others that will exhibit a significant amount of
So
volatility.
that in the range to expected return.
And
Why?
my personal preference is to have a longer band, be more cautious, especially with managers in this asset class.
You see a longer band because of Carol's question, what is that longer band?
To me, that means at least a year. But I am here to help guide decisions and navigate around a wide variety of different risk appetites. But this is an asset class that demonstrates a lot of volatility.
So what is this asset class that demonstrates a lot of?
Lots of small companies that are under followed by organizations like this and firms. And the risk that we potentially confront, we have experienced this unusual period of macroeconomic uncertainty, which some firms may have navigated very, very well.
This could end any game.
What? Yeah. Yeah. Wired. There is a risk of top ticking a firm that's been able to navigate this political uncertainty or geopolitical uncertainty a little bit better and have higher returns. I mean, we hired this manager for a reason, but we should have a long path with any sort of small path.
Yeah, all of them for a reason.
It is my unfiltered opinion.
All right.
Unfiltered.
Well,
So we'll be back in January.
yes, sir.
Any other questions about this? Any other questions about the futures?
This is the staff report, month to date, spec lending, around $183,000. North of 1.4 million, year to date, and there was 56 million since the program began. Diverse and local assets under management, 53% plus on a combined basis, just under 53% for diverse female managers, local and surrounding counties, 12.2%. And then the next three scheduled board meetings are December 2nd, January 22nd, and February 23rd.
Great.
I'm trying to save the sense of language. Could we make the file just a little bit bigger?
I wonder.
Yes.
Carol.
I said, I know he's trying to save the city some money on paper supplies, but could he please?
Oh my gosh, I did see it.
This is next step, like, yeah. No, it's fine.
Well.
Okay.
I said, new business. So if we move properly and take a return, we are adjourned, we can call the full board into session. Is there a motion to ratify the action on that as committee? Second, all those in favor? Aye. Those opposed, any abstentions, motion carries. Any new business? Any old business? Crossing your turn, we're adjourned. Thank you all very much.
Thank you.
Right, Chris, I didn't get that email. Yeah. I didn't know what happened. So, I like that. Excellent. Yeah. City G was not getting that.
Something with.
I don't know.